Okay, imagine this. You've done the really hard work. You've spent hours poring over financial statements, reading annual reports, and you finally identified 5 truly great Indian companies. Let's say we're talking about heavyweights like Asian Paints, HDFC Bank, TCS, Pidilite, and Bajaj Finance. Great, but now comes the million-dollar question. What do you actually do next? Seriously, how much of your hard-earned money goes into each one? Do you play it safe and put 20% in each? Or do you take 80% and dump it into your absolute strongest conviction? And wait, is 5 companies even enough? Should you own 20 or maybe 50? Welcome to this explainer. I want you to think of this as a mentor's whiteboard session. Today, we're shifting our mindset away from basic stock picking and we're stepping up to the much higher order skill of portfolio construction. Because, picking stocks and actually building a portfolio are 2 completely different beasts. And by the end of this, I'm going to show you why portfolio construction is often the exact thing that actually determines your wealth.
Here is our roadmap for today's session. Number 1, the great debate. 2, sizing methods and Kelly math. 3, the coffee can strategy. 4, buy and sell rules. And finally, number 5, the portfolio blueprint.
Section 1, the great debate, concentration versus diversification. Let's get right into it.
Right, so let's dive into this eternal debate about how many stocks you should actually own to protect and grow your wealth. This is literally the foundation for everything else we're going to talk about today. Now, there are 2 completely opposing philosophies that dominate Wall Street and Dalal Street. On one side, we have the academic approach, modern portfolio theory. This is that classic don't put all your eggs in one basket mindset we've all heard a million times. It preaches broad diversification, usually a minimum of 20 to 30 stocks, to reduce what they call unsystematic risk. This is the exact engine behind your standard mutual funds and index funds. But on the other side, we have the concentration model. This is the strategy famously embraced by legends like Warren Buffett, Charlie Munger, and incredibly successful investors like Manish Pabrai. Actually, Pabrai literally runs his family of hedge funds inspired entirely by the Buffett model. Their whole philosophy? Put all your eggs in one basket and watch that basket very, very closely. They hold maybe 5 to 10 stocks, period. It offers the potential for massively higher returns, but, and this is a big but, with significantly higher individual risk if you happen to be wrong.
Warren Buffett famously said that diversification is protection against ignorance and that it makes little sense if you know what you're doing. But look, as your practical mentor here, I have to give you the older brother truth on this one. Concentration only works if you have immense discipline, unbelievably deep knowledge, and plenty of time to dedicate to research. The honest truth? For about 99% of retail investors, a moderately diversified approach, somewhere around 15 to 20 stocks, is just much safer and way more realistic for your everyday life.
Section 2, sizing methods and Kelly math. How much money actually goes where?
So once you've decided roughly how many stocks to own, we immediately hit the next hurdle. Because knowing what to buy isn't enough. You absolutely must know exactly how much to buy. Here are the 5 main methods of position sizing that the professionals use. Method 1 is equal weight. Super simple. If you have 20 stocks, you put 5% in each. It's clean, and it completely removes emotional bias. Method 2 is conviction weighted. This means your highest conviction gets the biggest chunk of your capital. This is exactly how Buffett operates, with Apple making up a massive, massive portion of Berkshire Hathaway. Method 3 is risk parity. This one adjusts size based on volatility, meaning your safer stocks get the bigger positions. Method 4 is the Kelly Criterion, which is mathematically optimal, and we'll unpack that in just a second. But method 5, this is the hybrid approach, and honestly, it is the absolute sweet spot for retail investors. It means putting maybe 60% of your money in a super high-quality core of equal-weighted stocks and leaving 30 to 40% of your portfolio free to take larger conviction-weighted bets on your absolute favorite ideas. Let's look a bit closer at method 4, because the history here is absolutely fascinating. The Kelly Criterion is a mathematical formula developed way back in 1956 by a guy named John Kelly, a researcher at Bell Labs. Get this. Originally, it was used to figure out the optimal bet size in gambling, just trying to maximize long-term wealth growth without going totally bust. Over time, the smartest guys on Wall Street looked at this and adopted the exact same formula to calculate optimal investment sizes based on probability.
Now, don't let the algebra scare you off. I'm going to strip away the complex calculus right now. The formula is basically just the probability of winning multiplied by your win-to-loss ratio minus the probability of losing, all divided by the win-to-loss ratio. Look, let's make this incredibly tangible using an example from our sources, Bajaj Finance. Let's say you've done your analysis, you've run the numbers, and you believe there's a 60% probability that the stock goes up 50% in 2 years. That leaves a 40% probability that it drops 30%, right?
You plug those numbers in, your 60% win probability, factoring in your 1.67 win-to-loss ratio, and you just let the formula do the heavy lifting.
And boom, the formula spits out 36%. Pure Kelly math dictates a massive 36% allocation of your entire portfolio for this single hypothetical Bahaj bet. And guys, this brilliantly illustrates why relying purely on math can be really dangerous in the real world. In investing, probabilities are never perfectly fixed. They're just our best estimates. Because of that estimation error, and honestly, just the sheer emotional volatility of having over a third of your net worth tied up in one single stock, most professionals use what's called a half Kelly. They take that 36%, they cut it straight in half, giving a much more manageable 18% position. It's a fantastic mental model to use. Size up when the math is heavily in your favor, but always protect your downside.
Moving on to Section 3, the coffee can strategy, the incredible power of holding forever.
Let's see how all of this builds into an incredibly powerful long-term strategy. We are talking about the famous coffee can strategy, which Robert Kirby conceptualized back in 1984, and Saurabh Mukherjea later brilliantly adapted for the Indian market. The backtest results for this strategy are, well, they're absolutely staggering. The concept itself is beautifully simple. Buy elite companies, put them in a metaphorical coffee can, and literally do nothing for a decade. Just look at the data. Between 2000 and 2015, Mukherjea's Indian coffee can portfolio delivered a compound annual growth rate of 21.6% compared to the broader Sensex at just 13.6%. To put real hard numbers on that, an investment of 1 lakh rupees in the broader market grew to about 6 lakh rupees. Not bad. But that exact same 1 lakh invested in the coffee can strategy, it exploded to over 19 lakh rupees. Think about that. No trading, no emotional churn, just the pure, unadulterated magic of quality compounding.
Now, how do you actually find these stocks? You don't guess. You use strict, unemotional mathematical criteria. The filter is ruthless. The company must have grown revenues by more than 10% year over year every single year for the last decade. On top of that, it has to have maintained a return on capital employed of over 15% every year, and it needs a market cap above 100 crore. This mathematical meat grinder filters the thousands of stocks in the Indian market down to just 10 to 15 elite quality compounders. You end up with absolute champions like HDFC Bank, Asian Paints, Pidilite, and TCS.
Section 4. Buy and sell rules. How we eliminate emotional trading.
So everything's great when stocks go up, but what happens when the market crashes? Or what if a stock suddenly doubles? The honest truth here is that your portfolio will absolutely fail if you trade on emotion, which is exactly why we need hard and fast rules for when to buy more and when to sell. Let's contrast the two. You buy more, meaning you average down, when a stock falls 20% or more. But, and this is absolutely critical, your original core thesis remains perfectly intact. If there's a broad market crash and a phenomenal company goes on sale, that is when you deploy capital. You do not buy more just out of momentum or some fear of missing out. On the flip side, you have very strict scenarios where you must cut the cord and sell. You sell when your original thesis is permanently broken. You sell when a company's competitive moat begins to erode, when corporate governance issues create a real risk of permanent capital loss, or when valuations become completely, unjustifiably extreme. And notice what is emphatically not on the sell list. You never ever sell just because the stock price dropped or because of some random rumor on Twitter.
Finally, Section 5, the portfolio blueprint. We are going to build your construction tree.
So, the crucial point of this entire explainer is bringing all this theory, the sizing, the Kelly math, the quality filters, the discipline, into an actionable, real-world blueprint. Let's head to the whiteboard and build your construction tree. Take a look at how this illustrative 13-stock Indian portfolio elegantly balances sector exposure. We have 26% in banking and financials, a hefty 36% in FMCG and consumer goods, 16% in IT, 18% spread out across auto, pharma, and capital goods, and very importantly, a strategic 4% cash reserve. This perfectly balances your sector exposure to protect you against sudden macroeconomic shocks while still allowing your hybrid, high-conviction bets enough room to run. Basically, if IT takes a sudden hit, your consumer staples are right there to anchor you. This is what professional portfolio construction actually looks like.
But hold on, before you go out and start building this tomorrow, we need to quickly review the most common retail mistakes that can completely destroy this perfectly balanced construction tree. Mistake number 1 is over-diversification. Holding 50-plus stocks, you've essentially just built an expensive mutual fund that practically guarantees mediocre returns. Mistake 2 is the opposite. Under-diversification. Putting everything into 1 to 3 stocks creates a massive risk of ruin. Then there's sector concentration. Just imagine being 80% weighted in IT right before the dot-com crash. It's a nightmare. Next up is style drift, where you randomly switch from value investing to chasing high-growth tech stocks just based on whatever is trending in the news. And finally, analysis paralysis, sitting there reading balance sheets forever, but never actually having the guts to deploy your cash.
So, how do we actually avoid those traps? We follow these 6 tactical execution steps to physically build and maintain your portfolio like a true professional. Step 1. Target a solid 15 to 20 stocks. Step 2. Build a dynamic watch list of 30 to 40 high-quality names that you actively track every quarter. Step 3. Be patient and wait for your pitches. Use an SIP style to deploy capital monthly, but always keep some cash ready to buy lump sums on those inevitable market dips. Step 4. Size intelligently. Keep your quality core positions around 4 to 6% and size your really high conviction bets at 8 to 10%. Step 5. Do a major rebalance annually. This is where you trim winners that have grown way too large and add to your losers, assuming the thesis is still intact. And step 6, honestly, perhaps the most important of all, document everything. Keep a strict investment journal detailing exactly why you bought each stock in the first place.
I want to wrap up this explainer with one more piece of wisdom from Warren Buffett that beautifully summarizes our entire session today. He said, "Our favorite holding period is forever." But remember, forever does not mean a blind hold. You have to construct your portfolio with intent, you have to size your positions with logic, and you must monitor your thesis with absolute discipline. I want to challenge you. Open up your own portfolio today and apply this construction tree framework we just talked about. See where you're overexposed. See where you might need to run a half-Kelly calculation. And let me leave you with this final provocative thought. If you were forced to put 100% of your net worth into just 3 of your current holdings tomorrow morning, which ones would survive the cut? Think about that. Thanks for joining me at the whiteboard today. Next time, we're going to dive into the thrilling, completely different world of special situations investing. We're talking mergers, spin-offs, and demergers. Until then, keep learning, keep building that tree, and keep compounding.